Listen up. Most business owners hate taxes. They treat the IRS like it's an enemy. But here's the secret. The tax code isn't a punishment. It's a playbook for how to run your business. And if you know how to read, you can save thousands on taxes every year, protect your business, and scale faster than all of your competition. I'm Harrison Patton, founder of Kaizen Accounting, and today I'm going to walk you through exactly how to treat the tax game and how to navigate it like a pro. This is the exact X's and O's playbook that I use with my clients to save them money on taxes and grow their wealth. So let's get into it. This is the Masterclass, the Business Owner's Tax Playbook. This is why taxes are your secret weapon. So here's the thing about the tax code. It's over 6,000 pages long, but 90% of it is not about how they're taking your money. It's about rewarding business owners who do the right things. Companies that understand this get rewarded for their behavior. They're using deductions, credits, and incentives to lower their tax bill and grow their wealth. They understand that the tax code is a roadmap for incentives, not a manual for punishment. And by the end of this masterclass, you'll know exactly how to use your money to lower your taxes and grow your wealth, just like my clients. So step one is to build the right foundation by selecting the right type of entity for your business. So most solopreneurs start out as sole proprietors, which is a great thing to start out because you're just getting your business going and you might not want to go into it full time and invest the money to form an actual entity. However, by doing this, you're leaving your assets and your money exposed in case of if you were to get sued, and also you're not setting yourself up properly for tax savings. So a sole proprietor is a good start, but you're leaving yourself open to no asset protection and less tax savings and no advanced tax strategy. So the first type of entity that I would recommend forming is a regular LLC. And so the steps to do that is first you're going to choose your state. What you're going to do is you're going to choose the state that you live in. You're not going to form a Wyoming or a Delaware LLC, no matter what all the online gurus tell you. There's no tax benefits to doing this, and you don't even get the asset protection that they promise either. Both of them will be by the state that you live and operate in. The next step is to pick a unique name. So you can use your state's website to see if the name that you desire is available or not. And if it is, you can always just do your LLC as another name and then use a DBA to go by the name, which a DBA is a doing business as, so you can go by the name that you desire. Next, you want to appoint a registered agent. So you can choose either yourself or you can hire a service to do this for you. Personally, I opt for choosing a service to do this for me for privacy purposes. So if you use a registered agent service, such as Northwest Registered Agent, which is the one that I use, no affiliation, then you're able to keep your home address and all of your personal information off of the state filing, which personally I choose to do for privacy purposes. Next, you'll file your articles of organization with your state. So this is your name, your business, your address, and a few other items of information about your specific business. Next step is to pay your state fee. Yes, sadly you have to pay a state fee, but it makes sense if you're going to be doing business within a state. This varies from $50 all the way up to over $200 depending on the state that you live in. So just make sure that you're paying your state what you owe. It varies from state to state. The sixth step is to create an operating agreement. So this is necessary even if you're operating as a solopreneur. It outlines ownership, profit splits, exit plans, and business strategy. This is very crucial in making sure that your business is a separate entity from you as an individual and legitimizing your business as a separate entity. The next step is get an EIN. This is essentially to create a social security number, but for your business. You'll use this for tax filings and for getting a separate bank account for your business. And the final step is to open a business bank account. So step one for tax savings in business is to build the right foundation, so the entity selection for your business. So most people when starting out will just be a regular sole proprietorship. So step one of setting up your business is to build the right foundation with your entity structuring. So most people when starting out will be a sole proprietorship. There's nothing wrong with this when you're just starting out and figuring things out. But what this does is there's no separation from you as a person and your business as an entity. So this leaves you with no asset protection, and you also have to be very careful about commingling funds using the same bank account. Additionally, as a sole proprietor, you can't really operate with high intelligent tax strategies just because there's no entity separation. The next progression is typically to form an LLC, which is your most common business entity structure. And so this provides you with asset protection, but no tax savings inherently just from selecting as an LLC, which I'll explain more later. But if done right, it does provide you with asset protection and creates a separate entity from you as a person and your business. And eventually what you'll want to do is set up as an S-Corp and make the S-Corp election with your LLC. What this does is allows you to save on self-employment tax for the future, which is a different strategy in and of itself, but can help with saving an extra 15.3% on your profits. So let's go over the steps on how to properly set up your LLC to enable you to save money on taxes and protect your assets. So the first step is to set up an entity in your state. A lot of online gurus try to pitch the Wyoming or Delaware or Montana LLCs for the asset protection and tax savings, but I will be the first one to tell you that is completely false. You will be taxed based on the state that you live and operate out of, and also if you were to get sued, you would be judged by the laws within your state rather than the state that you're set up in. So don't listen to them. It'll just cost you extra state filing fees and won't do you anything for saving money on taxes. The next step is to pick a unique name. So this will be the LLC name. You can use your state registry website to check and see if the name that you desire is available. If it is already taken, you do have the option of picking a different LLC name and then doing a DBA or doing business as to get the name that you want that you'll go by when people search your website. So essentially, legally you'll be X, but on your website and everything, you're allowed to put doing business as Y. So I hope that makes sense. Essentially, you can say, I'm Harrison Patton LLC, but I'm doing business as Kaizen Accounting. The next step is to appoint a registered agent. So you're allowed to do yourself if you'd like, but you can also use a registered agent service. I personally opt for using a registered agent service because I prefer not to have my home address or any personal information on the state registry. It's really up to you, but overall, I recommend using a registered agent service such as Northwest Registered Agent. That's the one that I use, no affiliation, but it's up to you. You can do whichever you want. The next one is to do the filing of your articles of organization for your LLC. So this is where you'll provide the state with your name, info, your business information, the address of your business, and a few other items just so that you're registered with the state as a business. The fifth step is to pay the state fee. So every state, you have to pay a fee to run a business within their state. Kind of sucks, but it makes sense. The range of price for this can be as cheap as $50 or up over $200 in some states. It varies by state, so just make sure that you're paying whatever you owe your state. Next step is to create an operating agreement. So this will outline the way that your business runs. So this will be the voting power, the profit sharing, the exit strategy, selling of shares, all of that for your business. And you want to make sure that you do this even if you're a solopreneur, just to legitimate your business. There's a huge thing when it comes to the legal side of things and making sure that your business is a completely separate entity from you as an individual. Next step is to get an EIN with the IRS. This is for tax filings and getting a separate bank account for your business. And the eighth step for setting up your business is to get that business bank account. And this is so that your funds personally are separate from your business funds. You can still transfer in between the two, but you want to make sure that all of your business expenses are paid out of this business bank account. The commingling of funds can be a huge thing when you're dealing with making sure that your deductions and expenses are actually business purpose. And also, if you were to get sued, heaven forbid, you want to make sure your funds are completely separate, just so that your business is a completely separate entity from you. So yeah, that is how you build the foundation for your business. But next, what we'll do is we'll look at the second step, which is bookkeeping, which is the backbone of tax strategy. So bookkeeping is the backbone of tax strategy because if you have clean books, it enables you to be able to take a more aggressive tax stance. And so bad books equals lost deductions, overpaid taxes, and a risk of failed audit. It's inevitable that everybody would get audited at some point, even if you're a very clean business, just because of how the tax system works and the IRS audit system works. Everybody's going to face an audit at some point, but if you've done your bookkeeping correctly, audits are nothing to worry about as you'll be able to back up any expenses or tax stances that you've taken. By having good books, it allows you to be more aggressive on your tax strategy, and it also provides for business clarity because you'll know the financial situation of your business. And lastly, it adds for protection in audits. Like I mentioned, everybody will face an audit at some point, but if you have proper documentation of all of your expenses, then you have nothing to worry about because you'll be able to point directly to the expense that any auditor questions. And personally, I recommend just using QuickBooks Online for bookkeeping. It's simple, easy. They've added a lot of automation features and it's much more organized than using an Excel sheet or something like that. So that's what I use with all my clients and what I would personally recommend for you to use as well. So here's the steps of what you need to do. So first you want to gather everything in one place. So like I mentioned, you want to get everything on QuickBooks. So this would be linking all of your credit cards and business bank accounts so that all of the transactions that are running through that flow to QuickBooks. So the second step is to start categorizing. So you want to go through and categorize all of your income to the different sectors of your business. So if you do coaching but also have info products, you want to categorize the revenue based on what the revenue is coming from. So if you have revenue from info products, you want to categorize it there. If it's coming from coaching, then you want to do it to the coaching. This provides with financial clarity. It's not necessary technically for the actual tax preparation or tax strategy, but it provides for the business clarity side of things. I will mention if you do sell any sort of inventory, so if you're a physical product person, you will want to make sure that it's separate because you'll have to, on your tax return, label what the cost of goods sold was, which is essentially the cost of selling that inventory. And within the categorization, you want to make sure that you're matching receipts and keeping documentation of what the business purpose was for the expenses that you have. So if you go out to dinner and you want to make it a business expense, you need to make sure that you're documenting why that meal was for business purpose. So this would be things like noting what people were there, the time, and the discussions that took place. So if I was going with a client to lunch, I would put me and Sammy went to lunch and we discussed the tax strategy going forward for his company and what it would look like partnering up with him. And so you want to keep things like that for all of your business expenses, whether it be marketing, meals, travel, all of that, just so that if the IRS ever pointed anything out, you can directly go to it with the attached receipt and the attached business purpose of that expense. The IRS is typically looking for expenses that are $75 or more, but if your business is smaller, you might want to keep receipts that are even smaller than that. Just because of the scale of things, you want to make sure that all of your expenses are kept and all of your documentation is up to date. So the last step of bookkeeping to make sure that it's rock solid is the reconciliation. So this is where you'll look at what you have on QuickBooks Online and make sure that all of the transactions going in and out match what you have on your bank statements and your credit card statements. This is key to make sure that you didn't miss anything because you don't want to miss certain expenses that could lower your tax bill at year end, or you want to make sure that you got all of your income in from the previous month. A couple of other things that I would like to mention that you should do when you're doing bookkeeping. First is to look at your receivables and payables to other people. You also want to track your fixed expenses, so this is where depreciation comes in. So if you have a truck or any other depreciable asset, you want to make sure that you're tracking that depreciation on your QuickBooks Online or at least on an Excel sheet and just keeping up to date on that. Additionally, you want to keep payroll records, so if you have employees, you want to make sure that you're keeping proper payroll for those employees and making sure that you're deducting and withholding the proper taxes, the FICA taxes that go along with those salaries. And lastly, again, for my inventory-based companies that sell physical products, you want to make sure that you're tracking your inventory levels and your quantity that you have in there, the cost of them, and also tracking the cost of goods sold, whether it be the actual cost of the raw good, and you also want to make sure you're tracking the shipping and all that goes into the cost of goods sold for the product. So by doing all this, it enables you to have a better picture of what your financial situation is, but also it enables you to know what's going on in your business, where your money's going, and start doing high-level tax planning to actually lower your tax bill by year's end. So step 3 is unlocking the tax deductions. Here's where it really starts to get exciting. So the most important thing for you to know is section 162A of the tax code. And what this says is that anything that is ordinary and necessary for you to run your business in the pursuit of income is able to be a business expense. So it's a very broad definition that the IRS provides us. And basically, if it's normal in your industry and will benefit your company in the pursuit of creating more revenue, more sales, then you are allowed to take it as a business expense. It's important to note though that it should be reasonable. It can't You can't just deduct things just saying that it's a business expense when it's really not. You want to make sure that it's reasonable for your industry and common practice in your industry. So examples of this are like marketing expenses. So this would be video editing. So the first example is like marketing. So like video editing, software costs from creating your content, whether it be Canva or paying for Premiere Pro, After Effects, things like that. Or even running paid ads can be a deduction for you because it's a business expense. You're doing it in the pursuit of generating more sales, getting more clients, and yeah, you're able to deduct things like that off the end of your tax bill. Next would be travel. So if you're having to travel for business purpose, whether it be your airfare, your hotels, or Uber from places once you're in the actual destination, you're able to deduct those off your tax bill and they're able to be business expenses for you. And in a second, we'll talk about how you can use travel as one of the many things that can benefit you by creating a certain type of lifestyle around your business. Next is professional services. So using an accountant, attorneys, if you pay for coaching or consulting with your business, those are all allowable expenses that are going to be tax deductions at the end of the year. Next is your vehicle. So there's two ways to do this. You can do mileage, which the IRS gives you a certain rate per mile traveled, or you can do the actual cost of your vehicle. If you have a lot of expenses, if you have a lot of repairs, gasoline, other things going on with your car in a year, this might be the better option, but most people, mileage is the go-to that I would recommend. And lastly is the home office. So if you're working out of your home, if you use an office at your home rather than a physical building that you go to, then you're allowed to deduct a portion of your rent or your mortgage, your utilities, insurance, and internet, all off of your tax bill at the end of the year. Once again, it's important to note that you have to keep documentation of all of these. You can't just say it at the end of the year, because if the IRS comes knocking and wants to ask, they're going to be like, hey, what's your proof that this was all for business purpose and helped you generate revenue for your business? And as for things being reasonable in your industry, just always ask, would my competitors do this? Is this normal for my industry? And does it actually help my business grow? And remember, documentation is so crucial here. You want to make sure that you're documenting everything, whether it be taking your receipts and putting them on digital in a Dropbox or whatever, and you want to make notes of why everything was a business purpose. As for some of the other things like travel and home office, we'll get into in just a second in a little bit more depth so that you can learn how to turn your personal travel into business expenses that are write-offs at the end of the year. It's important that you're attaching these receipts to the expenses in your QuickBooks Online, just so that if the IRS ever questions you, you're more than prepared and it can quickly handle any IRS audit by directly pointing to that expense and showing the receipt and business purpose. This audit-proofs your business and makes sure that everything is okay if you are ever faced with an audit. So now, let's get into the most exciting and the biggest needle mover for a business owner in terms of their tax strategy and lowering their taxable income. All right, so now we're getting into the part that really separates the business owners who are professionals and pay a lower tax versus the normal ones who sit around every year complaining about their tax bill. So it's important to know the IRS does not want you broke. They want you to grow. They want you to stimulate the economy. That's why they've written the tax code in a way that if you do the behaviors that they want, that they will reward you with incentives for turning your personal life into a business. The IRS wants to reward you for your personal expenses by turning them into business expenses. Let me break it down. So I'm going to give you 3 examples. There's plenty more, but these are the 3 that I feel are the most common and the most applicable to all business owners. So the first one is your cell phone. So think about it. You're using your cell phone to text your friends, scroll Instagram, whatever. That's all normal. But you're also using your phone to write business emails, make business calls, and overall conduct business while on the go. So if you're using Slack, making client calls, all that on your phone, you're able to take a percentage of your cell phone use and turn it into business use. So what this looks like is, say, the cost of your phone and your monthly phone bill. You can take a percentage of that and credit it to business expenses. This allows you to deduct a portion of the cost of your phone and your monthly phone bill. It's important though when you're doing this to make sure that you are doing a reasonable estimate. You don't want to say that your phone is 80% for business when in reality most of the time you're sitting there scrolling TikTok. For most people this would probably fall somewhere in the 25 to max 40 range, but even that might be a little too high. So you just want to make sure that when you're taking a deduction like this, you're not going too aggressive unless you can document it. Once again, you can document phone logs and the actual business use if you'd like, but you want to be careful with going too far on this. So next one is travel. So most business owners don't realize that they can turn their personal travel into a business purpose trip. And this is all completely legal. The IRS allows you to deduct things like hotels, airfare, meals, travel while there, all of that, if you're able to find business purposes for your personal trips. So examples of this would be like client meetings and industry events. If you go to like big training for your industry, things like that are what you are able to structure your travel around to make it to where your personal travel is a business purpose travel. So just remember, it needs to be reasonable for you to do this, but any activity that you do while on your travel, you're able to, any activity that you do on your travel, if you're able to connect it to generating more revenue, getting more clients, or selling more of your product while you're traveling, then you're able to structure your travel to where the whole trip is a business trip. That's a huge portion of your vacation that is now turned into a tax write-off. It's important to note that the personal parts like lounging on the beach and nightlife or family hiking trip or whatever is not able to be part of the deduction. But if you structure it right, your travel, your meals, your hotel, all of that is able to be deducted on your travel for your tax return. But please, please, please remember to document. Everything in this needs to be heavily documented because travel is one of the most scrutinized things that business owners face from the IRS. You need to be able to prove that it is a reasonable business purpose trip if the IRS comes knocking. And here is the big one that I find with a lot of online entrepreneurs especially. This is your home and your utilities. And this is the big one that I find with a lot of online entrepreneurs. And this is your home and your utilities. If you're working from home, a portion of your rent, your mortgage, your utilities, and your internet can be written off. So in order to do this, you must have a dedicated space for operating your business. So if you have a spare bedroom, that works fine. So if you have a spare bedroom, that works perfect. I've seen other people dedicate a space and section it off from the rest of their house. What you have to remember is that the section of your house that is your home office should be sectioned off from the rest and solely and regularly used for business purpose. To back this up, you should keep proper documentation of the space with measurements and also other things that show that it is only used for business and not part-time as a bedroom when people come visit. It even helps to do things like logging hours that you're in the office to show that it's used regularly. Really, anything that you can do to show that this is your primary working space is something that you should do. And once you've defined your space, what you can do is you can use the home office square footage percentage divided by the overall square footage of your home or apartment, and this will give you the percentage of your rent, utilities, and internet that you're allowed to be tax deductible. So for example, if you have a home that is 250 square feet, and for example, if you have a home that is 1,000 square feet and you have a 250 square foot spare bedroom that you use as a office, you're allowed to deduct 25% of that utilities, rent, internet that I've mentioned off of your tax bill at year's end. It is important to note that it should be reasonable. If you're primarily working, then you can go a little higher. But if you're doing a lot of scrolling on TikTok, a lot of watching TV and all of that, even in the rest of your house, then you should be reasonable and say that only 15% of your utilities, rent, and internet are actually devoted towards your business. Another thing I would like to make sure that you're aware of is that this should be your primary place of work. So if you have an office building that you do all of your sales, you do all of your management and all that out of, then that's your primary place of work and you can't take the home office deduction. If you have both, there are ways that I've seen, such as with dentists and doctors, that they're able to show that both are used and that you can take the home office deduction, but there are a few more hoops that you need to jump through. So you're already spending all of this money, and the IRS says that you can deduct it if it's a business expense and legitimate, so why not take advantage of it? The mindset shift that you need to realize is to stop separating your personal life and your business life and find ways that you can put them together so that you can lower your tax bill at the end of the year. If your lifestyle fuels your business, then the tax code is written in a way that it can benefit you. But I will reiterate one last time here. The golden rule is documentation. You can't just say I used my cell phone on my trip to Bali, so it's a write-off. You need to keep proper logs, proper documentation, receipts, business purpose, all of that if you're going to be wanting to take these deductions. If you do this the right way, it can make a tremendous impact on your year-end taxable income. And if you do it right, then you're able to slash your tax bill at the end of the year, all while living the same lifestyle that you're doing right now, and it makes a tremendous impact on the taxes owed, but also in fueling the growth for your business in the future. So next, I just kind of want to hit on some common mistakes that I see entrepreneurs make, especially when first starting out. And so the first thing is mixing personal and business expenses. This is a huge thing. It makes the water so muddy and makes it hard to take deductions and hard to justify things if the IRS sees all of your money flowing from your personal expenses to your business expenses all out of the same bank account. You want to make sure they're separate and that you're creating separate bank accounts. That's the right way to do it and the way that you should do it. Next is not legitimating the business. So if you're stuck operating as a sole proprietor and you never actually set up an LLC and create ways that you're showing it's a legitimate business with an operating agreement and board of advisors, all of that, then you're just not doing it right. You can't just go on LegalZoom and purchase an LLC license and call it good. You need to do things like setting up a board of advisors and proper setup for your LLC. This will save you in asset protection, but also enable you to higher level tax strategy. And lastly, the thing that really hurts people for their tax strategy is not documenting. You can't be as aggressive if you're not documenting all of your expenses, all of your income. It sounds like a headache, but I promise once you get in a rhythm, it's much faster and it's really not that bad. And it's also so worth it at the end of the year if you're keeping notes on business activity throughout the year. This means all of your expenses, everything that you do, you want to keep notes, because if you can do this, you're allowed to be very aggressive on your tax strategy and it'll save you so much money, thousands upon thousands by the end of the year. So if you avoid making these mistakes, then you're gonna unlock the ability to major tax deductions and major tax savings. I'm talking 15 upwards to 40% tax savings each year, depending on where you are starting when you're watching this video. So yeah, just make sure that you're not making any of those mistakes. And I just wanted to reiterate and just kind of wrap up this video and just hit on all the points that we've talked about. So the first step is the entity structuring. Make sure that you're getting a proper LLC set up. When you're making around 40K net, you want to switch to an S-Corp and make sure you're being taxed as an S-Corp to save on self-employment tax. Next thing is get your bookkeeping in order. This is crucial, as you've seen, for the future deductions and lowering your taxable income and having a clear financial picture for your business. Next is to track your deductions. You want to make sure that you're keeping track of all business expenses and making sure to maximize turning your personal life into a business. So turning those personal expenses into business expenses. And the fourth thing is the documentation. As I've mentioned, keeping proper records of what's going on in your business and how all these expenses add together to be all for generating revenue for your business is so crucial. Just in case the IRS ever comes after you and is questioning you, you can point directly to the expenses and get that handled nice and quickly. And last step is just to have the tax savings. This is what everybody's looking for. Nobody likes giving money to the government. They want to put it back in their pocket or back into their business and fuel their growth. So if you follow these steps, then you'll be able to do that, and you'll be able to fuel the growth of your company and set yourself up for the dream life that you've always dreamed of. So in conclusion, taxes are not a burden. The tax code is made out to be this evil thing, but in reality, it's just an incentive playbook for business owners. And it shows you how the government will reward you if you take certain behaviors. So if you take these steps that I've outlined in this video, then you will be able to lower your taxable income and build the dream life that you've always wanted. And if you'd like help doing this, you can book a free discovery call with my team by clicking the link down below in the description. And if you want us to help you with cleaning up your books, finding the expenses and finding the deductions that you're not thinking about and not sure about, then you can schedule that with us and we'll do all of it for you. I run an outsourced accounting company where we handle it all done for you, from the bookkeeping to the payroll to the tax preparation, and also, of course, the strategic tax planning to help you lower your taxable income. So I hope you found this video helpful. I hope that I will hear from you in the future and hear that you've been saving thousands of dollars on your journey of building a business. And I hope that this really helps fuel the growth for your business. And yeah, book a call down below if you'd like help. Feel free to comment and ask any questions. I'm happy to answer any questions that you may have. And yeah, I hope you enjoyed, and I'll catch you in the next one.